Okay, hi, good afternoon, everyone. So, thank you for being here with us today. We will be presenting again the Philippines in time of COVID. So, I am Angelico Llabres, Equity Research Analyst of First Metro Securities. Here with me are Jules Cruz and Royce Aguilar of First Metro Securities Research Associates. So, for several years, the Philippines has experienced a remarkable economic growth, translating into improvements in consumer spending, growth of local businesses, inflows of foreign investments, and better public and private financial positions. With the recent COVID-19 pandemic, which hit several countries across the globe, including Philippines, this winning streak has been challenged, and the country's resilience was put to test. Our report tries to assess the current status of the country in this battle against the health crisis. We try to assess the efficacy of the measures employed by the government and the intervention of private sectors to cushion the socio-economic impact of the pandemic. We aim to solidify our claim of a domestic recovery post-pandemic by establishing one, the domestic economy stronger than ever to withstand near-term shock caused by the COVID-19. Two, the public and private actions to aid the marginalized and vulnerable sectors strengthen our belief in the comeback of the domestic economy. And three, the success and growth of local corporations in the past several years helped them build a strong balance sheet to better survive in this crisis and return to their pre-COVID growth trajectory. So, for to discuss the current status of the COVID situation in the Philippines, here is Jules Cruz. Jules.
Hi, good afternoon, everyone. So, to start, one of our main ideas is that the COVID 19 situation in the Philippines has been improving due to quick and decisive government actions. For my part, first I'll talk about the government actions and then I'll talk about their effects on our health statistics. So, the government actions for a quick list. Among what the government has done so far are the implementation of the enhanced community quarantine or ECQ. Number two, the ramp up in accredited testing labs, which resulted in better testing capacity. And three, the increase in healthcare capacity in terms of beds and equipment. Let's start with the ECQ. So we were actually the first country in Southeast Asia to implement a lockdown. And because of the early implementation of the ECQ, the Philippines had one of the biggest declines in movement of persons. This is according to Google's mobility reports. So it shows that so far, people are really staying at home and minimizing the risk of contagion. Now, we acknowledge that less movement means freezing our economic drivers and it will hurt the economy, but we remain positive on the ECQ given that it slows down the spread of the virus and encourages an eventual recovery. In short, the ECQ was like a necessary sacrifice. So on top of the ECQ, the DOH now has 20 accredited testing labs, resulting in a ramp up in testing capacity to 12,000 tests daily. Aside from this, there are 50 more testing labs pending approval, and the goal is to have a capacity of 30,000 tests per day by end May. If we compare our testing stats to the rest of the world, we are actually just slightly below the median. Let's turn our attention to the y-axis or the vertical line of this graph. That's the number of tests conducted scaled to the thousands. And as of May 8, we conducted around 126,000 tests, while the median of 83 countries was around 135,000. So clearly, we're not so far behind in terms of testing. And in fact, we're part of this big cluster of countries in the lower left that have conducted a similar number of tests. Only a few countries have conducted more than a million tests, including the United States with around 8 million. So this is important because we must remember that conducting enough tests allows us to gauge the true extent of the virus in the country and implement the appropriate containment measures per region. Now for the x-axis or the horizontal line of the graph, this one shows our positive test rate. So far, only around 6% of Filipinos tested end up being a confirmed case for COVID, while for the rest of the world, it's around 8%. So we are slightly better. In addition to increased testing, we have also been increasing our healthcare capacity. There's been a jump in number of beds and equipment, and right now, majority of these are still available. only around 40% of beds for COVID patients are occupied, and only around 20% of ventilators are being used. This is important information because generally, the Philippines is a bit behind its neighbors in terms of healthcare capacity. But now, knowing that a large portion of our beds and equipments are still available, we are not overwhelming our healthcare capacity, and so far, we are capable of containing the virus in terms of beds and equipment. We also want to highlight that 65% of cases are concentrated in Metro Manila, and this is like a double-edged sword. It makes it easier to isolate cases and implement focused containment measures, as the other low-risk regions slowly ease restrictions and transition into a modified GCQ. We also appreciate that the government is very careful in lifting the restrictions and making sure to listen to the advice of health experts. So now that I've discussed what the government has done so far, what have been the effects of the ECQ and the ramp up in testing in healthcare? Well, the effect of these actions has been an improvement in cases, mortality, and recovery compared to how we did a couple of months ago. Also, most of the country's COVID stats are now comparable or at par with global statistics. So to start, daily new cases have stabilized in the low hundreds. This is even after we started mass testing. So if you look at the chart on the left, the peak of the new cases is way behind us. That was around March 31 when we had more than 500 cases, new cases in a day. Also, if we compare our COVID cases to other countries, adjusted for population, we only have around 97 cases per 1 million people. If we rank the countries this way, we're actually in the bottom half. And we think that this is because we are really staying at home because of the early lockdown. Moreover, because of better healthcare, our mortality or fatality rate has now improved to 6.7%. That's slightly lower than the total mortality rate of COVID around the world. For context, we've reached as high as 9.6% mortality sometime before, so there's really an improvement in that area. In addition, our young population with a median age of 25.7 years is a good thing to keep our mortality rate low. Because remember that COVID related deaths usually come from complications or diseases normally found in the older population. Improved healthcare capacity has also led to recoveries rising faster than deaths since April 15. And you can see this in the chart on the right, where the red line started to intersect the gray line above. And we see no signs of this trend reversing anytime soon. So, bottom line, the COVID situation in the Philippines has been improving because the government acted quickly and prioritized the health of the people. And the earlier we become healthy, the earlier the economy can recover through gradual lifting of restrictions. But of course, it's not all about health. We are also acknowledging that COVID is putting downward pressure on our economic growth. So to address this, the government and the central bank are also working on keeping the economy afloat through fiscal stimulus measures and monetary policy. Here's Royce to discuss the economic relief and recovery programs by the government.
Okay, good afternoon, everyone. So here in our slides, here in the next couple of slides, you will see how the government really put in all its efforts in curbing the socio-economic impact of the COVID pandemic to all of us, especially the whole economy. So to specify, first, the Bangko Sentral ng Pilipinas, what they did specifically was they lowered policy rates by 125 bips to 2.75%, and they reduced the reserve requirement ratio by 200 bips. So bottom line, what they did was this helps the banking sector, the banks, the BDOs, the BPIs, the metro banks, because it helps them withstand given the slower domestic economic growth that we are expecting. Of course, moving forward, the lowering of the policy rates, the reduction of reserve requirement ratio, this will be the same bullets that will fuel the economy. So of course, specifically, this will help SMEs for their operating expenses. This will also help the bigger businesses. Of course, now we have heard news regarding lower capital expenditures for the year. And moving forward, once those big businesses, the ones listed in the PSE, once they begin increasing their capital spending again, it will be supported by lower interest rates. Of course, another is they lent the government 300 billion, so via repurchase agreement, and they advanced the remittance of 20 billion of dividends to the national government. Of course, this helps the government in terms of their spending for relief related, in terms of giving goods to the people, especially the low mid-income households. Okay, so next slide. So that's after the BSP. Now let's move forward with the government and their 1.45 trillion rescue package to combat the crisis. And of course, now let us talk about this in under the sectors. Let's dissect it using the sectors of the economy. So first, the households. Of course, we know this social amelioration program or SAP, and the government allotted around 200 billion for it. Of course, this was given to most of the households, and the LGU also pick up the slack to give those that are not covered by SAP. So that's under the household. Of course, bulk of consumers are from this segment, so this helps them at least spend on their basic needs. Next is the 120 billion allotted for the MSMEs, the smaller businesses. And of course, SMEs are the most vulnerable part of the economy right now. Of course, they can't stand on their own given the crisis. But we cannot not support our SMEs. They grew so much in the past few years, and the government is here to help them survive because keep it's noteworthy that both households and the SMEs are integral part of our economy. So this is a good move by the government. And of course, under the third here is the BIR pushed back income tax payments. And of course, now this may be a short-term negative given the government may receive lower government revenues for the year. But let's just say this is a short-term pain for a long-term gain. Of course, again, given the support for the vulnerable groups right now, and they are integral part of the economy, and we cannot not support them. Okay, so let's dissect a bit in the next slide. Okay, so you will see on the right side of the slide is the sources of government funds. So the question here is, can the government afford to spend 1.45 trillion? And the answer is yes. Of course, while these fiscal measures to contain the coronavirus will resort maybe in the near term fiscal out of the country, keep note that the country remains one of the more financial stable emerging economies. Of course, you will if you total actually the sources of government funds, excluding the tax revenues, it's around 1.15 billion. But note the tax revenues expected for the year are nearly 3 billion. And as of first quarter alone, we already had around 700 billion. So the government can spend this much. And keep note that the public debt to GDP ratio of the Philippines has fallen from a record high to multi-decade lows now. So bottom line, the government has enough financial buffer to really spend to support the economy. And this is good news for us because this has been some of the sentiments of other people. If the Philippines, if the government can spend, and the answer is yes. So okay, so next.
Okay.
So Iko.
Hello, yes. So for the post-ECQ recovery program, so the COVID-19 crisis in the country does not end from the lifting of the ECQ or resumption of the business operations. For us to say that the crisis is already behind us, we need to see normalization of business activities towards its pre-COVID state. However, we acknowledge that there are sectors who are more vulnerable to the effects of the health crisis and who need further help even after the lifting of ECQ to survive and return to normalcy. With this, the government is preparing a Philippine Economic Recovery Act, which aims to jumpstart economic recovery and further support the marginalized and vulnerable sectors who we think are important for robust and sustainable economic recovery. As part of the program, the government allots 110 billion in wage subsidies to help the labor force who were directly affected during the pandemic, such as the OFWs, self-employed, and essential businesses. This is transitionary in nature. So moreover, we acknowledge that the gravity of COVID-19's impact on MSMEs, tourism, and agriculture and fisheries. So the government allotted more than 500 billion to support these industries to recuperate from their operations. Around 10 billion in assistance will be provided for MSMEs by the Department of Trade and Industry, while 25 billion MSME loan programs will also be set up. An amount of 10 billion will be earmarked for our agriculture and fishery sector and 43 billion for the tourism sector. Some 66 billion in assistance will also come from the Board of Investments. Tariffs on certain imported raw materials will also be lifted and grants for the manufacturing of COVID-19 goods will be provided. The bill also proposed structural interventions, which include 48 billion in refinancing of loans and 300 billion worth of zero interest rate loans by state-run Land Bank of the Philippines and Development Bank of the Philippines to local businesses. The bill also proposed a disbursement of 650 billion to bolster the government's build strategy to continue the growth momentum of infrastructure development in the country. As part of the risk mitigation post-crisis, the government also crafted the Balik Probinsya program, which aims to diversify economic growth outwards Metro Manila. In this manner, we spur business activities outside and diversify economic risk brought by business concentration. Moreover, with this, we foster inclusive growth and will unlock business potentials outside city centers. So with the assumed recovery of the market given the financial health of both private and public sectors, as well as their collective actions to soften the impact of the crisis on the economy, we believe that there are sectors and companies who are at better odds than the others in surpassing this crisis. For our picks, we believe that select consumer and property companies are in better positions to withstand this transitory shock and are poised for a strong growth momentum upon business normalization. So to discuss the consumer sector, here's Royce again to discuss the positive drivers and the risk of the sector as well as our top picks.
Okay, so hello again. So to discuss, of course, as mentioned in our previous webinars, consumer sector is our top sector pick. And I would like to discuss specifically why. So first is, of course, in the whole consumer sector, the trend right now is the shift to staple spending, right? We are seeing food staple manufacturers, groceries, as the ones that being relied on by consumers, right? We are seeing the likes of Pure Gold, we're seeing the likes of Century Pacific are the ones really operating normal and actually receiving more demand than usual. And this may be the trend afterwards, given that consumers will or households will focus more on spending their needs rather than their wants. So next is catch up spending during post-crisis. Of course, the tendency is under discretionary spending. One is clothes. Of course, there's tendency that once the malls open, you will tend to spend on the ones that you did not purchase while you were still in your home, and that's one of which. Next is socioeconomic safety nets. Of course, this is mostly for the low-income households, of course, to cushion the potential loss of incomes. Various government agencies have committed to provide direct support to affected labor groups and workers. So we are seeing wage subsidies, unemployment benefits, and even the early release of 13th-month pay bonuses. So that supports our case that the household can buy their needs, at least the basic ones. So there, of course, and just to be specific on the stocks, of course, the price drop due to the negative sentiment across the local market was also spilled over to the consumer names a bit. No, but keep in mind that compared to other businesses, these consumer names, specifically the consumer staples, the consumer non-discretionary, are nearly full, if not fully operational. So bottom line, the price drop of these companies maybe not is not warranted. So of course, there may be pent-up demand supported by the high savings rate of the households. So of course, let's also talk about the key risks. Of course, if there's prolonged containment measures, More stringent containment measures in the form of lockdown extensions, should there be protracted travel bans, it will delay the rebound in the sector, right? So there. Another is downturn consumer sentiment via, for example, if there are uncertainties relating to peace and order, if there will be slower rebound in the availability of jobs and income, should there be further concerns over public health and community lockdowns, this may affect the spending behavior moving forward. So this is very important, especially once ECQ or GCQ is lifted, especially in NCR, what's the spending behavior going to be like? So that's something we are waiting to observe. Another is contraction in OF remittances. So that's overseas Filipino remittances. We are seeing some OFWs are actually returning here, right? So that's due to slower global economic growth, lower demand for imported labor. So that affects the usage of remittances. So, and to specify a bit on our picks, now, these are our picks. We reiterated, emphasized that these are our top consumer picks. And why? Because they belong to these consumer staples. They are the beneficiary of needs, the basic needs, the buying of basic needs. And we call these stocks consumer staples or consumer non-discretionary. So first, URC. So we like URC mainly because the likes of the Jack and Jill, the C2s, the noodles, these are the ones you will see in the ones people donate, right? So specifically why we like URC is mainly because of its domestic branded consumer business, meaning it earns well here in the Philippines. So based on its recent earnings, it's seeing some headwinds in the international business, and that's expected. But what we like to see is domestic business to offset the international business, and that's what you're seeing. Of course, there's some upside in the Australian business, mainly because it has the same trend here in the Philippines, where some of the relief goods is filled with URC products. So that's for URC. For RHI, keep in mind that 77% of its revenues are currently operating the likes of the supermarket, the convenience store, and recently the hardware. So if you see some lifting of ECQ, GCQ, RHI will also benefit since the likes of its toy stores will also open. And basically, what we like about RHI ever since before is the recovery of the Rustan's business and how quickly they turned it around. And since since Rustan's is now earning, it's not net loss anymore, it will now contribute to the robust business model of RHI. So next is Pure Gold. So for Pure Gold, this has been the outperformer amongst all index names. That's a fact. And it's mainly because all of its stores can operate. Its Pure Gold stores, its SNR stores are filled with demand. So of course, it's noteworthy that the first week of the ECQ, it saw 50 to 100% increase in demand. And what we like about Pure Gold moving forward is the lower inflation, the lower price of rice. It will benefit its target market, specifically the low income household. So that's all for consumer.
Hi, for the property, so the property sector has been badly hit by the negative sentiments brought by the pandemic. We see most stocks trading below 1 to 2 standard deviation of their historical price multiples for the past couple of months. Despite the fact that we acknowledge the impact of COVID-19 in different subsectors of the industry, such as small leasing and residential segments, we believe that the drop in prices is overdone and it discounts the long-term strength of the domestic real estate market, and that big property developers in the countries are well diversified with strong financial arsenal to withstand the near-term decline in revenue. Also, we believe that companies are adapting well to ensure the sound financial position. Example is cutting capex and delaying their projects so that they position themselves for a strong recovery post-crisis. For our pick, we favor property companies with healthy financial positions such as Ali, RLC, and SMPH. So discussing the strength of each of the real estate segments. So number one, we believe that the demand in office leasing business will remain robust amidst the marketability of the domestic BPO market and the growing global concern on reducing cost in implementing business continuity plans. Although there are people who might be concerned on BPOs going out of the Philippines to diversify their operations, we think that most BPO companies will look into spaces outside Metro Manila for diversification instead of outside the country. We believe that labor cost and leasing rates remain competitive in the country and that we have a huge pool of talents that suits their needs. Second, residential sales might be impacted given the construction delays, which will impact revenue recognition and lower launches. However, on the bright side, we believe that huge project launches of local developers in the past couple of years will keep residential sales afloat. Moreover, although we acknowledge the risk of slower sales growth as people delay purchases of discretionary items and investments due to the lack of confidence on domestic market, we think that low interest rate environment will support sales and will keep low default on existing residential sales. Given the stable residential leasing prices and possible resumption of POGO businesses in the country, the local residential market remains to be a sound investment too. Lastly, tourism and mall activity. We believe that this sector will rebound post-virus scare after the virus scare subsides. So based on historical trends, Collier International suggested that tourist arrivals can rebound by approximately 20% after a virus outbreak subsides. So per DOT data, 2009 arrivals in the Philippines surged by 16.7% following the influenza AH1N1 virus when the WHO declared that the pandemic was already over. Although we also acknowledge that the tourism might take some time to recover given travel restrictions and issues on health security, we believe that we have a strong domestic market which will cushion that impact so that we see local hotel businesses to be in better position to recuperate by focusing their marketing strategy on domestic market while waiting for the resuscitation of the foreign tourism. So to close this one, so we think that the improvement in the domestic COVID-19 situation is manifested in several facets. So number one, implementation of ECQ coupled with improvement in testing capacities in healthcare system, which we hope will translate in better figures in terms of recovery and decline in number of cases. We are positive on the action of the government to address the needs of the marginalized sectors during the pandemic and constructive plans in reviving the economy after our battle against the virus. We also believe that amidst the long-term growth of the corporates and long cycle of business expansion, that enables corporations to beef up their financial position and withstand the short-term risk of slower economic growth. Moreover, we see corporates better adapting in the situation by reallocating capital and reassessing business strategies to cope with near-term market weakness and position themselves in anticipation of market recovery. Most corporates retain low leverage ratios, enabling them to have enough financial space when needed. And lastly, we believe that this weakness is transitionary in nature and that we are already in the right path towards recovery, as seen with better numbers and gradual easing of community quarantine measures. We are now positioning our portfolio in companies and sectors who we believe are resilient despite the crisis and who have robust growth driver post-pandemic. Thank you.
All right, so we'll move on to the questions of our audience. So first question is, okay, we saw which sectors you are bullish from. So how about which sectors of the economy are likely to recover the slowest?
Okay, so probably for us, we're a bit bearish in terms of the gaming sector, given, of course, we see tourism to gradually recover, or probably restrictions will still be high up until now and even up and after COVID-19. Given that gaming facilities are usually crowded, people will be a bit hesitant to go to those properties. Moreover, I think the gamers or the gamblers are actually, well, they have now an option to go into online gambling if they want to really do, do gambling activities. That reduces their risk of exposure if ever there's still a second wave of the pandemic.
Okay, thank you. Okay, so some quick question, and I will answer this quickly also. So, what do you mean by overweight in each of the sectors? So, this means that these sectors are the ones, bottom lines, they're the ones who are a buy for us. And of course, we specified in our slides that not all stocks under the consumer sector are a buy. So, we specified specifically which are the ones you're going to buy. But bottom line, overweight means the ones that you, out of, for example, out of the 10 stocks, we do recommend having at least 5 or 7 of which under the sector. So it's something to that effect. Okay. So next question is thoughts on the construction related stocks now, given the gradual easing of restrictions in the industry.
Mm, okay. So I believe we remain cautious on the construction sector given that liquidity is generally thin amongst those companies. Although we remain bullish in the infrastructure sector given that there are tons of projects in the pipeline and we believe that the government will still be pushing through with that after this pandemic. But the question now is more on the survivability of these companies who really solely rely on the construction business. So, however, there are companies that are a bit more diversified than just being a construction company. So those companies might withstand the risk in the near term and they can recover after that. So, but right now in the construction, even though they're opening up right now, they're doing operations right now. The question is one is liquidity, two is the logistical concerns, given that I think there are some of the goods actually are still in the ports right now.
Okay. So the next question is if the government's virus response can be considered early and effective, how are the countries that acted later able to open up their economies and borders sooner than us? So I think Jules will answer.
Okay, hi. Thank you for that question. So, in the reopening of economies, we highlight that execution is of utmost importance. We think that our government was rightfully being cautious and making sure that when we do reopen the economy, there will be a solid basis for it. So they're consulting the right experts on it, and they're also making sure that the social distancing measures will be enforced effectively. Take note also that if other countries reopen their economies earlier, it is actually to our country's advantage that we get to see from their example if there will be for example, a potential second wave of COVID, and if it is actually feasible to reopen the economy as early as now.
Okay, thank you. Okay, so next question is what's our index level target and 2020 and estimated PE? So as mentioned in our webinar, our monthly wrap up, our year-end target is now around 8150 to 83, and the estimated PE for that is around 17 times PE. Of course, that's still cheaper compared to the crisis last 2008, 2009. Of course, keep in mind, as we always mention regarding the year-end target, that's in terms of fundamentals. That's how we evaluated the index. So the question is it is it is that sure that you will reach 8150, 83? Of course, that still depends on the price action as well. You have to combine both um, analysis for that. But the question is, for example, by end 2020, if we're not at 8150 to 83, bottom line, we still think the market is cheap. So that's basically the bottom line for it. Okay. So next question is, assuming by late second half, the pandemic has eased, given the high savings rate and probable tapering of residential prices, do you think we'll see residential demand rebound back to where it was last 2019 or 2018?
Hi. Okay, for the residential sector, of course, it's a discretionary consumption, as I said. So people who are still in doubt of their, or probably they have concern on job securities, then we won't be seeing surge in demand after that. So of course, if you look at consumption, if you look at recovery of consumption, that will be gradual, starting with non-discretionary consumption and not on investments until the market gain more confidence uh, in the recovery, then that's where we see the residential prices going up. However, right now, what I'm saying is that for this year, at least I'm seeing stable prices of the residential sector. and moving forward until when people get more confidence in the recovery of the domestic market, then we see a spike in the in the purchases. Because right now, as what I'm hearing from other developers, it's not a question of whether they can buy or not a property. It's a question of how confident they are that the market is growing, that the market is stable. So there, so given after post-COVID, we will see confidence improving and we will see gradual improvement in sales of residential.
Okay, thank you. Okay, so next question. This is regarding the new IPO Merrimart. So what do you think about investing in Merrimart? It's also part of the food industry, right? So to be specific, Merrimart is the same as um, like some grocery retailers. Of course, they have these three segments. But the bottom line in terms of is it worth investing in Merrimart? I think given this part of environment, for us, no, I think in a nutshell, we do think some other consumer companies out there here already listed are already trading at cheap valuations. We do think that investors will flock to that first and watch how this IPO will go. So the tendency here is for Merrimart, it's good to the question is it good to invest? I think, for example, for us, I think we have to fully evaluate the company first before we make really an outright recommendation. But in terms of what we are noticing, we do see some investors really flocking first to the cheap stocks right now. You see the PSEI just trading the range, not really going down significantly, despite uncertainty. And it's because they're picking up these stocks that are cheap. So to answer your question, it is in the grocery industry. It also has this part of inside the Merrimart where it sells pharmacy and the like. So based from my initial research from that, they're planning to expand to around 100 stores by end next year, if I'm not mistaken. That's another risk, of course. How certain it is that given the uncertainty in the construction and the like, how will they and execute their expansion plans that way? Of course, if they fall short in their execution plans, that's also a risk in the share price and the earnings forecast of whoever analyst covers them. So there, no, I think for now we have to fully evaluate first Medimart, but as of now, I think investors are flocking first to the cheap consumer names. So that's several risks for the IPO itself. So there. Okay. So next question, to I guess a follow up for the construction industry. Are most construction companies ready to comply with the GCQ requirements, especially the lodging? The added expense might slow down the restart of construction works. So
Hello. Yeah, I think I can just what's this guess on that one. But I think the bigger companies, the bigger construction companies will be able to comply with that. And I don't think that's a huge expense on their part, given that other construction companies, even without the policy of the government to provide lodging to their construction workers, are already providing those kinds of amenities to their workers prior to the COVID. So, but for the smaller ones, probably that's a bit of a concern, given of course, parang they won't be able to provide that support to their to their employees if they're just a small construction company.
okay. Um, Jules, you want to add something or
None for me.
okay? Okay. So next question that we have is Mrs. G. So that's Metro Retail Stores Group Inc. Worth considering given that we're also bullish on Pure Gold. I guess we're not covering Mrs. G, but I guess another problem when we're not covering Mrs. G is mainly because of the lack of liquidity in the company. Of course, it has the same nature as Pure Gold, but keep in mind that not all stores or segments of Mrs. G is open. Keep in mind that 30% of its earnings or revenues comes from the department stores, which are not open as of the moment. So it may be different compared to Pure Gold because Pure Gold, all of its segments, it's only kasi grocery and it's all operational. So that's a big difference, especially now. You can compare probably Mrs. G to RHI, given that some of RHI segments are not open, but nevertheless, Mrs. G is not trading as liquid as the other stocks, so there might be a there may be a risk if we recommend it, especially to our bigger clients. But it might benefit. Mrs. G might benefit in this kind of environment, but again, we have to see the impact of in its earnings on how the department store closure will impact. Because Miss G is quite a smaller business compared to our recommendations. That's why it may be a different story in terms of earnings impact. So there. So, let me switch on the questions. Okay. So question is it how will a second wave of COVID-19 affect your forecast now? If it happens? Yeah.
Hello. Yeah, probably for us, first, the reason why we applaud the government for gradual easing of the enhanced community quarantine is because we see that the government being careful in terms of lifting the ECQ just to prevent the second wave of the pandemic. However, if that's the case and we see second wave of the pandemic, uh, that of course will weigh down on our valuation. Given that, of course, for us, we expect that the recovery will start at the latter part of this year. But if the economy will close again and restart the ECQ given the second wave, then that will cut again our earnings up until next year. However, we're positive that the second wave should be we should be of a better position in the second wave than in the first wave, because in the second wave, at least first, our healthcare are already there and are ready to accommodate increasing number of cases. And second, we already know what to do in terms of policies and guidelines on how to combat and how to contain the pandemic after that. So yeah, of course, it's a negative. First, well, it's a negative thing for our valuation. That's very obvious. But second, we think that it's relatively likely to happen given the progress in the containment measures. And number three, if it happens, then we're more ready than the first wave. So the impact should be lesser than what happened in the first wave.
All right. So next question we have is the ramp up of testing enough? The ramp up of testing here in the Philippines, is it enough? So Jules, maybe.
Hello. Okay, we think that the testing has been enough because take note that in early April, there were days when we had as low as 800 test results in one day. But nowadays, there are days when we have as much as 7,000 plus test results per day. And more importantly, we have a high testing capacity. So if there are more requests for testing, we can go as high as 12,000 tests per day. We can address these. Also, the government is targeting 30,000 tests by end May, and they said that they need to get that testing capacity by hook or by crook. So they're ramping up the accreditation of testing labs in order to accommodate these testing requests. And again, this is important because it gives us a better idea of where we really stand in this crisis.
Okay. So next question is it a good time to buy stocks and invest in index funds now? Again, no, that depends on your um, timeline of investment or investment horizon. So of course, if you're trying to invest in the next 3 or 5 years, it's definitely good to invest now because in terms of stock market price, in terms of the PSCI, it could go a bit lower and the like, but it's hard to catch the bottom. And we saw that when the market reached 4,000, midday, it closed at 4,600 at the same day. So it's really hard to catch the bottom, but definitely every time the market goes down, the risk to reward ratio is increasingly skewed to the upside. So to avoid missing out, you can buy index funds a bit now And again, to answer your other question, is it good time to buy stocks? Yes, specifically our stock picks. You could refer to the stock picks mentioned here. You can also refer to the stock picks we mentioned in the webinar. So there. So again, to not just to promote, just to say a fact, in terms of investing in index funds, one recommendation we have is to buy in FMETF. FMETF has a lower in terms of fees kasi it doesn't have any management fees, only transaction costs. So lower siya compared to index mutual funds. But of course, if you want mutual funds, you can find it in our FundSmart. So all the options you have, it's in our platform. So there. So next question is, do we have any outlook on REITs?
Okay. So well, REITs one, as we have discussed, we're very positive on the REITs. As number one, I think on the property sector, it has two benefits on my side. So number one is that it unlocks the potential of the properties that is enlisted in the REITs market. So of course, for example, you're a company and you have properties or leasing properties. The value of the properties are booked in your balance sheet at cost. However, if you put it into REITs and make it tradable, then you're unlocking the potential or the market value of your product. Second, on the property on the business on the property developers, it diversifies their source of funding. So other than just going in the bond market or increasing uh their their number of shares, then they can just give out their leasing business, a part of their leasing business, and then get those cash so that they can continue their growth momentum. So they can fund their businesses, their growth internally using the established leasing businesses that they have. However, right now, as we've seen, Ayala is still positive with their REITs listing, but they said that given the market condition right now, it's really hard because the pricing will be affected as well as the demand, because a lot of investors are a bit skeptical, and for them, it's better for them to keep their liquidity to themselves, to keep their cash to themselves before investing, because risk is there. So as for investors, the the propensity of people to invest depends on their appetite for risk. So right now, for other people, they might be seeing that the market is a bit more risky, and despite that, we see potential in the real estate market. Some people are not investing because it's still risky for them.
Thank you. Okay, so next question is, which crisis impacts the economy the more, the current pandemic or the previous financial crisis, and why? To be honest, we think this crisis currently has a bigger impact globally compared to the previous financial crisis. Mainly because we saw, just based from the numbers, we can base from the numbers. For example, in terms of GDP contraction, it's now more felt across the world. Because keep in mind that the financial crisis before stemmed or came from the housing crisis, the Lehman Brothers fallout in the US. It just trickled down a bit to us. But this health crisis that we have is both a health and a bit of a financial crisis. But there's a silver lining there. The global economy is also more prepared now compared to before. So we may be down now, but we're definitely not out. Especially compared to the global financial crisis before, because we're more prepared now. Philippines alone, we can take on more debt. The US has more financial muscle, and also as well as other countries. So that's the answer to your question. So I guess we have one more. So last question is, given the effect of the new normal in the airline industry, when do you see earnings to revert back to, let's say, 2018, 2019 levels? Will lower demand be offset by depressed oil prices?
Okay. So probably I can, well, technically we don't cover transport right now, but probably general comment on it. Well, first on the oil prices, I don't think that oil prices have huge impact on the transportation sector. First is that probably half of their oil consumption are hedged. so they won't be taking profit on that side. And second, they can just pass on the pricing of oils to their consumer. However, in terms of recovery, I said of in the airline business, you have two types of consumer. You have your domestic consumer and you have your foreign tourist arrivals. So for the domestic, I think it will be recovering after pandemic. We see like people in Manila going to beaches in the Visayan region or in the Mindanao region. But it's hard for me, or it's a bit I'm a bit more skeptical in terms of foreign arrivals coming from other countries going into the Philippines and from Philippines going out of the country, given that probably some borders will still be closed given the health security concerns. So right now I feel like, well, up until the end of this year I don't see airline recovering, probably up until next year. So because right now, of course, airlines will be more focused in terms of increasing their demand. So they're pushing for promos, marketing activities so that to jumpstart the demand in the airline business. But that will hit their margins, but and it will take a bit more time for them to recuperate from that.
Okay. All right, so that ends our webinar. So thank you everyone, and I hope to see you in our next set of webinars lined up. And personally, for me, I hope to see you or hear from you in our monthly wrap up by the end of this month. So thank you, keep safe, and have a good week ahead.